Investment. The latest CPI report just dropped, and it's grabbing headlines for a reason. Inflation is the economic term everyone seems to be talking about. Investment. Everything May's numbers give us a snapshot of what's happening to prices across the country. Whether it's groceries, gas, or rent, we all feel the effect in our wallets. This report isn't just numbers. It's a reflection of our day-to-day lives, showing us how much more or less we're paying for the things we need. Analysts pay close attention to which sectors are driving the increase. Is it energy, housing, or food? These details aren't just academic. They're vital clues for how the economy is moving and what might happen next. When it comes to the Federal Reserve, these CPI numbers are a key signal. The Fed's job is to keep inflation in check while supporting economic growth. If inflation is rising faster than expected, investment. They might raise interest rates to slow things down. If it's cooling, they could pause or even cut rates. Right now, economists are dissecting this data, comparing it to the Fed's target rate of 2% inflation. Every decimal point matters, and even a small change can influence billions of dollars across loans, mortgages, and savings accounts. It's a delicate balance. They want to avoid letting inflation spiral out of control, but also don't want to stifle growth. For individuals, these rate decisions directly impact your finances. Higher interest rates mean your credit cards, mortgages, and loans could get more expensive. That $200 monthly payment on a variable mortgage could suddenly climb, affecting your budget. On the flip side, savings accounts and CDs may yield slightly better returns, which is a silver lining if you're holding cash. Investors also need to pay attention because rate changes influence the stock market, real estate, and bond yields. Understanding how these numbers affect your personal finances helps you make smarter choices, whether it's paying down debt, adjusting your budget, or deciding when to invest. Finally, this moment is also an opportunity. Every period of economic uncertainty brings both risks and chances for savvy individuals. For long-term investors, dips in the market might be an entry point. For savers, higher interest rates can make low-risk accounts more appealing. But the key is to stay informed, avoid panic, and make calculated decisions rather than emotional ones. These CPI numbers aren't just statistics. They're a map showing how money is moving in the economy and how you can navigate it wisely. By keeping an eye on trends, understanding the Fed's signals, and adjusting your finances accordingly, you're taking control in a time when uncertainty seems to dominate the headlines. The latest consumer price index numbers give us a clear picture of how inflation is moving in the economy and why it matters so much to everyday Americans. Inflation isn't just an abstract concept. It directly affects the prices we pay for groceries, gas, rent, and even services like healthcare and utilities. The CPI report breaks down these changes by category, showing which areas are driving price increases and which are stable or even falling. For example, if housing costs or energy prices are rising sharply, it can make it feel like your paycheck isn't stretching as far as it used to. On the other hand, if some categories are stable or declining, it may offset the pain elsewhere, but overall trends matter most. Analysts compare the month-to-month and year-over-year changes to gauge whether inflation is accelerating, slowing down, or holding steady. Investment. These trends are critical for predicting future price pressures and for understanding the health of the economy. Importantly, CPI numbers also influence consumer behavior. When prices are rising quickly, people might cut back on discretionary spending, prioritize essentials, or even adjust savings and investment strategies. In short, the CPI is a mirror of the economy's pulse, showing both the challenges we face and the opportunities to make smarter financial choices. Investment. The Federal Reserve closely monitors the CPI because it's one of the most important indicators of inflationary pressure in the economy. When the CPI shows that prices are rising faster than the Fed's target, typically around 2%, it signals that the economy might be overheating. In response, the Fed can raise interest rates to slow borrowing and spending, which helps cool down inflation. Conversely, if the CPI indicates that inflation is under control or even falling, investment. The Fed may decide to pause rate hikes or even cut rates to stimulate growth. Every CPI report gives the Fed a snapshot of where inflation stands and influences their next move. These decisions aren't made lightly. Investment. Raising rates can make loans, mortgages, and credit cards more expensive, which impacts consumers and businesses alike. But not adjusting rates can allow inflation to spiral, eroding purchasing power and creating uncertainty in the economy. Investors, homeowners, and everyday consumers all watch these numbers closely because they directly affect borrowing costs, investment returns, and financial planning. Essentially, the CPI acts as a guide for the Fed for effect to balance economic growth with price stability, and each new report can shift expectations about where rates are headed next. Understanding this connection helps people anticipate changes that affect their wallets. The latest CPI numbers don't just influence the Fed, they have a direct impact on your personal finances. When inflation rises, the cost of everyday goods and services increases, which can make it harder to stick to a budget or save for long-term goals. Items like groceries, gas, rent, and healthcare often see the first effects, and even small percentage changes can add up over time, affecting your overall purchasing power. On the other hand, when the Fed responds to inflation by raising interest rates, borrowing becomes more expensive. That means higher monthly payments on variable rate mortgages, credit cards, and personal loans. For someone carrying debt, this can significantly strain their budget. Conversely, higher interest rates can benefit savers. As savings accounts, certificates of deposit (CDs), and money market accounts may offer better returns. Investments are also affected. Stocks, bonds, and real estate can react differently depending on the inflation environment and interest rate expectations. Being aware of these connections allows you to make smarter financial decisions. For example, investment. You might prioritize paying down high interest debt, adjust your spending habits, or explore investments that perform well in a rising rate environment. In short, CPI data isn't just abstract economics. It shapes your daily financial reality. Periods of economic uncertainty, like those highlighted by new CPI numbers, create both risks and opportunities for investors. When inflation is rising and interest rates are potentially going up, certain assets, like bonds or cash, may lose value in real terms because their returns might not keep pace with inflation. On the other hand, investment. Stocks and companies that can pass costs onto consumers or benefit from rising prices can offer protection and even growth. Real estate can also play a role, as property values and rents often increase with inflation, creating a hedge for long-term investors. The key is understanding how different investment types respond to changes in interest rates and inflation. Diversification becomes critical during these periods. Spreading investments across multiple sectors, asset classes, and geographies can reduce risk while positioning your portfolio to take advantage of growth areas. Staying informed about trends in consumer prices, Fed policy, and economic indicators allows you to make calculated moves rather than reactive ones. Ultimately, the CPI report is more than just a number. It's a guide for adjusting investment strategies, good investment, protecting wealth, and seeking opportunities that align with your financial goals. By paying attention and acting strategically, investors can navigate uncertainty and potentially turn it into advantage.